How does LTV ratio impact my HELOC application? Imagine trying to borrow money against your home and wondering what the lender looks at first. One of the biggest factors is your loan-to-value ratio, or LTV ratio. This number shows how much of your home's value you owe in total debt. It's calculated by dividing your current mortgage balance by your home's appraised value. If your home is worth $100,000 and you owe $50,000, your mortgage LTV ratio is 50%. When applying for a home equity line of credit, lenders also consider the combined loan-to-value ratio. This includes your existing mortgage plus the new loan you want. They divide the total of both by your home's value. For example, if your home is worth $600,000 and your mortgage is $250,000, and you want to borrow up to $100,000 through a HELOC, the combined LTV ratio would be calculated as follows. Adding your mortgage and the HELOC amount gives $350,000. Dividing that by $600,000 results in a combined LTV of 58.3%. Most lenders prefer that your combined LTV does not go over 70% to 85%. This means you need to have at least 15% to 30% equity left in your home after the loan. If your home is worth $600,000 and your mortgage is $250,000, you could typically borrow up to around $150,000 through a HELOC if the lender allows an 85% combined LTV. That's because 85% of $600,000 is $510,000. Subtracting your existing mortgage leaves you with a maximum of about $260,000 in total debt. And since you already owe $250,000, you could borrow around $10,000 more. Having a lower LTV ratio makes your application more attractive to lenders. It shows you have more equity in your home, which reduces their risk. This can also help you qualify for better interest rates on your HELOC. On the other hand, if your LTV ratio is high, meaning you owe most of your home's value, lenders might see you as a higher risk. They could deny your application or offer you a smaller credit line with a higher interest rate. Lenders use the LTV ratio to protect themselves and you. It helps ensure you have enough equity to cover the loan if you sell your home or if property values drop. This ratio also limits how much they are willing to lend, keeping the loan within safe boundaries. When you manage your LTV ratio well, you improve your chances of getting approved and may get better loan terms. In summary, your LTV ratio influences how much you can borrow through a home equity line of credit. It affects whether your application gets approved and what interest rate you might receive. Keeping a healthy LTV ratio means you have enough home equity to support your borrowing needs and secure favorable loan conditions.